So much for being here. If everyone could take their seats. There you go. Excellent. All right. Thank you all so much for coming through the fog and the mist to be here today. I'm Eva Lewis. I'm the Executive Director of the Affordable Housing Conference of Montgomery County. It's so good to see you all here. You are about to experience a roundtable where you're going to get into depth with these experts on their particular lane within our housing environment and housing system. I also want to just remind you all of a couple things. One, since 1991, we've been putting on a big affordable housing summit. How you doing, Chair? The Chair of the Planning Board is here. Thank you so much. We've been putting on a huge affordable housing summit on the back of your program. It is May 9th. You'll receive more information about that as it comes up. Two, you all, hopefully you picked up our journal. If you didn't, please take 1, 2, 3. I want to get rid of them before 2025. But we are working on our 2025 journal. So the journal submissions, we keep it very broad. It just needs to relate to housing, affordable housing. And the deadline is January 10th. I will be here till the end. So if you'd like to learn more information about that, please do contact me. 3, money, sponsorships. We need sponsorships for the summit. If you're interested in being a sponsor for our summit, please feel free to contact me. And know that obviously those sponsorships go to the summit, but more importantly, they go to our Break the Barrier contest, which is our contest where first-time home buyers in Montgomery County, we provide anywhere from $5,000 to $10,000 for closing costs. So if you have people in your network or clients, when that information, it'll be on our website in January. So please spread the word for our Breaking the Barriers contest. Excellent. Now I'm going to pass it off to our co-chair, Ralph Bennett.
Does this work? Me?
Try this one. You may have to.
Oh, you got, I never got a green light.
Yes.
Good morning. It's good to have you here. I bring greetings from Barbara Goldberg Goldman, the doyen of affordable housing in Montgomery County. We're especially pleased to have Chairman Harris here from Planning Board, the embattled chair of the Planning Board, doing the good fight, and it takes a long struggle and a lot of patience, and he deserves all of our support. And it's just great to see him here. I have known him since he was in the development side, and it's a terrific treasure that you're taking that job. Barbara, yes, excellent. Barbara sends her regards, had a sudden commitment that she had to make. I want to thank you all for coming. Do seize the opportunity to write something about affordable housing for our journal. There are some good articles in there. My specialty has become building energy performance standards, which are a big threat to affordable housing for those of you who build it. But there's a whole lot of other things going on as well. I also want to take a moment to remember Sally Roman. Sally was a number of things, including active at the Planning Board, but she also was Commissioner and Chair of the Housing Opportunities Commission, which both Barbara and I have done as well. And Sally died in early November, and she was a member of our board, always a source of truth about planning issues, and a wonderful citizen of this county. So think good thoughts about Sally. So that's my story. We'll see you on May 9th. You must come. And I'm going to turn it over to Casey Anderson.
Thanks, everybody, for coming. I have wanted to do a panel like this for a long time because I've had so many conversations over the last, whatever it's been, 10 or 15 years that I've been involved in land use, real estate development, affordable housing, where people don't even start with a baseline understanding of the economics of what it costs to build, what it costs to finance, residential development, what it costs to operate. And I think unless you have those building blocks, it's very hard to have an informed conversation about what we can do to make housing less expensive. So if there's a subtitle to this, it ought to be, there is no one weird trick. There is only the slow boring of hard boards. And it's like everything else in life. If there's a big problem, there's usually not a simple, straightforward solution that has evaded everyone. So today we're going to talk not just about the difficulties, but also about some of the things that can be done to make this easier and less costly. But I also hope that people are going to come away from this with a better understanding of why it is, in fact, difficult to build anything. And so with that, I think we want to get started and get right into it. I'm going to introduce just briefly our panel. We've got Ed Barnett, Director of Rental Lending from DHCD, from the state, who's going to talk about some of the state's financing tools that are available to develop affordable housing. I've got to my right, Tony Davis-Spivey, who's a mortgage specialist at Truist, who's going to talk about some of the lending programs that are available, what they make possible and what some of their limitations are. Got Alan Goldstein down at the right, who's Vice President at AHC, who's worked on a couple of projects in the county, but has extensive experience going back many years in developing affordable housing, very sophisticated about finance for affordable housing. And we're going to start with the market rate developer, who is Matt Hopkins, who's an SVP for Mid-Atlantic region at Ahcmc. He works on development, construction, acquisition for the entire northeastern United States. And the reason I wanted to start with him is because by walking through the building blocks of what it costs, what are the elements of the use table in a pro forma, how do you finance market rate development, then we can then turn to some of the people who are involved in building subsidized housing to see what the layers of complexity are that come on top of that. But the basics are bricks and sticks, and that costs money, and that's why we're starting with Matt to kind of walk us through that. Matt?
Yeah, thanks. Hi, can everybody hear me? Great. I'm, like Case said, I'm Matt Hopkins. I work for a national REIT, so we're a real estate investment trust. Ahcmc, we go really everywhere in the United States. At the moment, we're focused on just a few markets, really because of a bit of the chaos that we're all very well aware of. We're focused on the Front Range in Denver, Miami, or South Florida, really, and the DC, Baltimore area. At the moment, we've got properties across the U.S. and have a 50, 60-year history of developing multifamily products, particularly in urban, infill, large-scale, high-rise, mixed use, hopefully. So just, I think my task is an easy one today, which is just to say this is hard and expensive, very expensive. My investment class, which is the general public, anybody investing in our stock ticker, expects a modest return, something a little bit more, let's say, than a T-bill or something that requires no risk, because what we do has an enormous amount of risk. A little dip in the economy, and we're paying $500,000 a month extra in carry costs every month, and all those profits just evaporate. So we expect demand, my investors demand a little bit more than a base rate return because of that risk, right? Reasonable request, demand. So if it was easy, I wouldn't have a job, and if it was a little bit harder, I probably still wouldn't have a job because I'd be out of it pretty quick as soon as I didn't make those returns. So I think Casey sort of charged me with taking what we run around in these huge, 40-tab Excel sheets all day long, and we argue across tables, and we tear our hair out trying to figure out where the levers are to pull. But in reality, there's only a few things that affect those bricks and sticks, that affect actually being able to go up in a building or renovate a large, redevelopment of a building to bring, buildings don't last forever, to bring a building back up to something that's livable, or respond to the market or whatever it is. So there's the total development costs. Let's just dive right in. So no pretty stats. I'm not going to bore you like anybody else. We'll just go right to it. Total development costs. Pretty simple, right? Land, it's a big one. Tends to come behind changes in the economy. So even though interest rates might go up and you would think that would reflect lower land costs, it's not happening. They're just both going up. So that's a double hit. Hard costs, obviously. We have inflation, which means folks are getting more money in their paychecks, which means it goes into the hard costs of a building. So those hard costs have gone up way up, astronomical. So I was going to show you a little bar chart, but we won't do that today. They've gone way, way up, and it's probably the biggest hit in the entire pro forma is our hard costs.
Matt,
Not
Matt, first tell us what hard costs are.
It's literally paying a general contractor to build the building. So it's a GMP, it's a fee, whatever it is, but it's the actual costs that go into a project. It's the tiles, it's the flooring, ceiling, heating, electrical, everything that goes into it, not the land costs and not the cost to design it or fee it or impact fees or anything else. Finance fees, carry costs, operating costs, all that stuff is different. Hard costs is just actual stuff that you can touch and can't pick up and put in your car and walk away with. So and then soft costs is all that other stuff, design, fees, obviously, any kind of transaction or transfer fees, a whole bunch of stuff that always amazes me that it can get to 15, 16, 17% of the hard costs. So you would think that the floors and the ceilings would be 100 times what the soft cost should be, but it's not. So those soft costs are really growing. Financing, obviously, there's very few companies that are going to self-finance $100, $200, $300 million. So you typically need to take a good chunk of that and get a 3 or 4 part capital stack, what we call capital stack. So it's different financing, and I think some of these folks will talk a little bit about some other options for that. We'll have a construction loan, which is typically a bank or a large investment vehicle. They'll be typically full recourse or damn close to it. Sorry, it's our nervous loan because the bank can take back a building pretty quick, but they'll usually not go these days above 50, 55, 60 if we're great credit national REIT like us. Maybe get to 60, but probably 55% of the loan is going to be a construction loan, and you got to fill in the other 45%. So, sorry, $100 million loan, $45 million has got to come out of somebody else's pocket. So that's typically going to be mezzanine and a limited partnership piece. The general partnership, the actual developers doing the slog, doing the work, are going to be a little 5-10% of that piece. We're not running around with a bunch of money on the development end. We're doing the work and getting paid for it. The LP money is generally wants a much higher return because they're at the bottom of the list of getting returns should something go wrong. So they're going to want a lot of money. They're going to want 16, 18, 20%. A mezzanine loan is going to be, great credit like us, we can get 12, 14% mezzanine loans, but more typically, excuse me, for the small developers, it's going to be more like 16, 18, 20% for a mezzanine loan, the little piece in the middle that you're missing. So all of that adds up to a lot of financing costs. $100 million job, $10 million, rough. Fees, obviously, impact fees, all the rest of that good stuff really starts to add up. Transfer fees, all that kind of stuff, millions of dollars. Proffers obviously come back in. They end up being either off-site or on-site. Public amenities, whatever you want to call it, they can end up being millions of dollars on a $100 million job. Sorry, getting a cold, I think. TDC incorporates all of that. So that total development cost is sort of cash outlaid to get to a building. And then you end up needing to rent it, obviously, get some income in order to start paying back all these folks that gave you $100 million. And then along with that comes all the operating costs, which also obviously we've seen an enormous amount of inflation on. So I used to be paying my very talented community managers and service managers $80, $90, $100,000 a year, good living. I'm now having to pay them $150,000, $160,000 a year for community managers and service managers. That bites right into that NOI. So yes, rents have gone up, and so has everything else. So which makes sense. So that net operating income, so that's all the income minus all my expenses. Simple, right? So I have my total development costs, what it costs to get that thing out of the ground and get it built, my net operating income, how much money we left over at the end of the day on a month-to-month, year-to-year basis, and then my yield, which is kind of the magic thing in development. It's a nice, simple thing that we can't cheat on. You can't, fudge, future inflationary rates. You can't mess with the tab in the pro forma. and make that yield look better. That yield is really nice and simple, and most banks and institutions and me, I really like that yield. And my investment committee, the first thing they ask me is, stop all your noise, what's the yield, right? And the yield is really simple, NOI divided by the total development cost. So it's your base return. So if you were to go and buy a piece of stock, let's say, and you bought $10 worth of that stock, and you got $1 back, that's a 10% return, right? And you would know what that yield is, 10% yield. And you could give it to a treasury bill and get almost a 5% today, probably in a few months a 5.5%. And then, or you could put it into a pretty aggressive CD money market and maybe get 6 or 7%. You could put it into some of the built together real estate pieces and get 7, 8, 9%. There's some loan pieces that'll get you 10 or 11%. Not guaranteed. There's some risk there, but it's relatively spread out. So it's not, you're not dependent on one piece of property overperforming in order to get your profit back. So that yield is competing with all those other investments. And if it doesn't do as well, or it's not predicted to do as well, and have a little bit of cushion in case it doesn't, nobody's gonna wanna give you that money. I don't wanna invest that money. Nobody should. So the yield really must be at least, and this is another one in my investment committee. I walk in every investment committee saying, all right, I've got a 1.5 over yield, over cap rate right now. And they're like, that's a minimum, not a must. So they're really looking for 2 these days because of chaos in the world. But a 1.5 over current cap rate. And so cap rate is a weirder thing. All the rest of it kind of makes sense, right? It's pretty simple. Bricks and mortar, financing, paying an architect, all that kind of stuff totally makes sense. How much you rent it for and how much you operate it for, pretty clear. The cap rate is a little fishier because there's a bunch of large institutions that help to analyze a market to say how much a building is worth. Now, in theory, it's built upon comps, right? So if the building across the street is a class C minus and it sells at a cap rate of 7%, which is just how much NOI it generates, obviously, divided by that total development cost, or whatever it's going to cost to buy it. So it really depends on how much money that building is making at the time it sells, right? The NOI of that building. If it sells at a 7 or 8%, then that's another comp that comes in and feeds the institutions that are telling us what the cap rates are. We do our own analysis and try and argue across the table with whoever we're selling it to, or in our case, more importantly, what bank we're trying to get a permanent loan for, right? We want a loan for $110 million. If we built a building for $100 million, hopefully it's $150 million, but something more than we spent to build it, really the goal. And if you're arguing with a bank about what that building is worth, everybody's opinion about what the cap rate is going to be valuable, but the guy selling you the building, his opinion is probably less valued than your own comp analysis, and it's also less valued than RealPage, Green Street, CompStar. A lot of those comp pieces, especially Green Street, have a lot of muscle these days. It changes, but in telling you what a area inside of a zip code cap rate should be for a certain product, the typologies, office, and then the ranking of an A+ to a D property. So that cap rate is kind of magical. That cap rate is everything that we really depend on. And we can take a quick peek if you go to the next slide. The biggest driver in our more complex, this is just this is the summary page. So this is it's probably a 40-tab thing that's just ridiculous, and I do it for a living, and I can barely make my way around it. But all this input, and it's really that today's NOI cap rate is a 5.4 in the Rockville, sort of North Bethesda area, and 5.4 is traditionally over the last 10 years about a half point higher. So it's 4.9, it's now 5.4. That is an enormous hit on the value of every building in the county. So especially in that area. So that half point is really a disaster to these pro formas. It undervalues the building or decreases the value of the building by an exponential factor because it's that, sorry, Casey, go back one. It's because it's NOI divided by a cap rate. Cap rate's a percentage, so it's a 0.054, right? Because it's divided by that much smaller number. The NOI, every dollar of income that I get off of the building is magnified by a much smaller number. So that little tiny, 0.054, if that were to drop back to 0.049, where it was a year ago, the value of the building goes up by almost 10%. Right? It's a huge exponential factor. It's simple math. It sounds complicated, but it's not. It's just a division. When you divide by a smaller number, exponential, right? So sorry, Casey, go back. So this is kind of the complicated summary, but next slide, Casey. So like we said, you figure out what your current today's cap rate is, and before I do anything else, when I'm looking at a property, that tells me I need at least 1.5 points higher than that on my basic yield. So my basic total development costs divided by my NOI, I need or other way around, sorry, needs to be 6.9, which is really high. I think most penciling in the county right now is probably at 6 or 6.2, something like that. Affordables, I'll bet you're looking at below 6 and thinking that's a win. But if I were to go to my investment committee and said, I'm only gonna get you a 0.5 point more than it's gonna take just to build the building, and you gotta take on all the risk, they'd say, no, go buy a T-bill and you can, learn how to play golf or something. And then, so I think, so once you sort of add up all those development costs, and you get some of your average rents, Casey, give me another slide there. It's, you get to what we're talking about, uses and sources, right? So you see just general scale. My finance costs, I started doing some wacky stuff on this one, which is to say, look, what if what if everybody was lined up behind me on this market deal? And we did all kinds of wacky stuff. Like I got a 3% mezzanine loan, doesn't happen. I got a very aggressive construction loan at 7%. What if I got, what if my carry costs were really low, meaning everybody wanted to live in this building and I got it leased up in 12 months, right? And so I had no carry costs. I was able to have income fast enough that I was able to pay off my, start paying my monthly loan fees and my monthly carry costs. Because that service manager is there 6 months before I open. That's carry costs. The loans kick in as soon as I open those doors. But they kick in before it. But there's a lot of added up interest and it starts hitting as soon as I open those doors. So if I'm leasing slowly and the income's coming in slowly, that's carry costs. So in here, I'm assuming, bang, everybody wants to live here. They got checkbooks and they're writing checks like mad, and we're able to cover our costs really quick. All that aggressiveness still means I need $36 million in equity, which is pretty typical right now. So it's hard for me to go to my aggressive, funding sources and get 36 million. It's even harder for anybody who is a more conservative, public company like ours, where it's very important that we only invest in things that are going to make our public investors, $1. That $36 million is a big chunk of change for a 1.3 or whatever our valuation is. $1.3 billion is our current valuation, I think. That's still a big chunk of that dollar figure, and our investors will not tolerate not making at least a decent return. So next slide, Casey. This is actually, and the other trick I did on the other one is I said maybe it's a ground lease, and the ground leaser is so generous that they're going to put it off until it's stabilized. Any lease payments, very generous. So, but if you went back and said the difference between 135 million, in case if you go back a slide, 110. So there's a $25 million difference here, right? Which is about the cost of land. Land's typically 125,000, 150,000 if it's right at a metro per unit, something like that. So in these quick performers, I ran very late last night, so I apologize. But is very aggressive, and actually just that land at zero at a land lease would also affect, in reality, it didn't affect in this pro forma because we're being optimistic here, but it would affect all those financing costs. Everything goes up 2% because there's risks with a land lease that there isn't in fee simple ownership, right? You own something, the banks go, I got it. I got something to go after. You lease something, the banks say, I got nothing. If you screw this up, I got nothing. Sorry, give me 2 more. So that this is the controversial piece, right? Maybe, because it affects people's actual lives, which is how much do you rent these apartments for? What is your income, right? We're working really hard to lower operation expenses, but the income side is the one that, you know, makes the press. It's the one that we're all putting out 20, 25, 30, 40% in some awful instances of our income directly into housing, right? But just to make this pro forma, which still doesn't work after all this, you know, shiny, optimistic stuff I stuck in here, still doesn't work, including $3.50 average rent, but that includes the MPDUs. So we're at 380, something like that on here. From a rent standpoint, those are huge. So you're gonna get an itty bitty, you know, 20 by 20, 22 by 22 foot studio apartment for $2,000 a month. That's rough, right? It's rough. It is, however, where we are at the metro sites right now in DC, lower, you know, southern metro sites. So give me the next one, Casey. These OpExes, you know, we're wrestling with them constantly, obviously. There's a give and take, you know, when you charge somebody $4 a square foot for an apartment, they expect a concierge, you know, somewhere in there's a tilting point where, you know, maybe we should charge them $380 and get rid of the concierge. But that's a short speak for, you know, just trying to control OpEx over how much we, you know, expect from amenities, physical amenities as well as staffing amenities. But trying to wrestle down that, you know, and this is unrealistic too. An 80% NOI margin is, that's optimistic as well these days on a luxury, on an A building, for sure. It's probably more like 75%. So if I'm only getting 75% of that rent back to my NOI. Here we're assuming 79.3, but so anyway, all that leads to without land, which is an expensive item. I'm only getting a 6.6% yield, simple yield. And like we said, I need a 6.9 just to meet the minimum investment threshold. And that's got it, and that's 1.5, like I said, my investment committee, my investors, banks, and everybody else, they all, you know, judge that 1.5 on, if it's sitting right at a metro and there really aren't many encumbrances, maybe there isn't a ground lease like here, maybe they can get away with a 1.5 these days. But if there's anything, any kind of hair on that beast, they really want 2%. They really want 2.5 if it's really risky. If it's 3 blocks over, you're a maze with no sidewalks to get anywhere, parking's low, you know, something else is encumbering that property, they're gonna want 2.5% over. So with all of that gymnastics and no land costs, I'm still only at 6.6%. So I'm considerably lower than where I need to be just for a minimum ideal development site. I add in the ground lease payments, it drops to 6. I add in my taxes, it drops to 5.25. So, so literally the yield, the true yield on this project, 5.26, with some other optimism in it, including deferred ground payments. So there's an IRR issue in there, but that's why yield is nice and pure. It doesn't have to do with time. That 5.26 is below the cap rate. I'm going to sell my building for less than I built it for. Not going to keep me employed. So nor does it make for the next building. So if I get a successful building, I can build another one, right? So we're talking about just volume of construction. As soon as you get a failure, you're out of that market. And you're not building the next one. You get a success, then you can build another and another and another. And then we increase the stock. What's the next, Ted? Time. This one gets complicated. IRRs, they sound complicated, but they're not. It's just money and time. And it's probably valuable to those of us who are long-term investors and are going to try and figure out when's the best point to refinance and all that kind of stuff. But in terms of figuring out whether a project's going to work or not, There's all kinds of games played. And the ones I made here, in order to get an IRR at project exit levered, to get a 17% IRR, I had to add back NPVs for, I made up all kinds of things. In this pro forma, I made up a pilot program that didn't need 25% NPDUs, only needed 10. I made up, I deferred the ground lease here. What else did I do? I had a 3% mezzanine loan rather than a 16% mezzanine loan. I did all kinds of wacky stuff, and I still only got a 17% IRR, which just means over 4 or 5 years, they're making an average of, 16, 17%, something like that. But all that stuff obviously doesn't really exist. And the yield is really what determines whether this project would move forward or not. What's my next one, Casey? I was just going to make the point. So just if you ask Green Street what the cap rate is today or last night, it's 5.4. As it gets a little bit oranger, it gets a little bit better. So he's slipping down here. It's a 5.2, I think, in that little bit of corridor around Bethesda. My next one is Northern Virginia. So just to poke everybody in the eye, I won't be building in Montgomery County anytime soon, as long as these are lower, right? I can go anywhere. My capital goes anywhere. Capital goes where it gets the biggest return. People used to say, wherever it's welcome. Capital doesn't care. You can beat it with a stick as long as the payment's there. But capital's going to go. There's a whole lot of orange and the darker beige in Northern Virginia than there is in Montgomery County. So cap rates are lower. Value of the building, exact same building, much higher, millions of dollars more in value, just because I built it in that square and not the other square. No other reason. Well, there's a bunch of reasons for it, but it's the next one. So I think getting back to this, go ahead and flip to the next one, Casey. And so, more typically, I'll look at 2 or 3 properties a day. Like driving here today, I was just almost late because I stopped and pulled over. There was a nice little piece of property. It looked like the right dimensions for a 200-unit building that had a little sign out front, from some little brokerage shop, which is probably means it's not just blanketed to the street somewhere, right? And it's not JLL or some big company that everybody in the world's going to bid on. So I got all excited about it. So first thing I did was pull out my laptop and do this little land value piece and look at a couple comps really quick on apartments.com or CoStar or something, and it didn't work. So, but the shocker, right? But developers are optimists. Everybody in this room, just by being at this conference, you're optimists. So this is my preferred page. This is kind of the one page or one tabber where I have my basic levers, right? Construction cost, the efficiency, physical efficiency of a new construction building, maybe. Which is just how much amenity space, how much corridor, how much can I squeeze this thing down? Is it a piece of property that looks like a bug that got run over, or is it a nice, beautiful little, contiguous rectangle or something that I know I can be very, very efficient on? And that number is actually, we didn't talk about it, but this number can actually be really devastating to a pro forma. Inefficient building with tons of amenity space and tons of unused space. Maybe the parking's inefficient, something like that. It's awful. It can destroy a pro forma really quick. That exit cap rate, the development spread in here, I have it. I say it has to be 1.5, which gives me that 6.9, which this little sheet just tells me I can only spend $83.7 million. I'm actually figured out I'm probably going to spend 101. I can move on to the next property pretty quick, right? And that's only assuming a $20 million property cost, which is only $100,000 per unit. Probably not at a metro. Probably off at a piece of property that hasn't been looked at before. Maybe it comes with a bunch of other risks. If this is at metro, it's probably more like 150,000, so 330 million. And that'll it's already blown to smithereens. It already doesn't work. But these are already making some assumptions that are realistic, but don't work. Total OpEx, I got it at 30%. That's probably optimistic, but doable. And that's all the levers I have to pull. That's it. Those are the only things that I have to push and pull on. The rest of the big pro formas. They're all, they're analyzing, all kinds of stuff and stress testing it and doing all the cash flows and trying to play a game of, dominoes, hopping over different financial ideas in order to get to something that maybe we can limp through until it stabilizes in an extra year. But that's dangerous work. Investors don't like that because it's a little bit of Excel pixie dust. This sheet to a bank, to an investor, says, hey, it doesn't work, don't build it. I think we're going to pull it up, Casey. So just to make it, I guess, clearer, maybe. Casey, if you just put, 300 per square foot new construction, that's, nowadays that's probably low. Certainly if it's a Class A, certainly if there's a lot of infrastructure involved, if there's any, we'll call it hard cost proffers, if I'm having to build a street in front or whatever it is, that number will go way up. So Casey, just type in 325 there, or I'm sorry, to the construction cost. 325 would be something I would probably normally start with. So it dropped to a 4.5 yield. So I'm almost a full point lower than than the current cap rate, and it's 2.5 points lower than where my minimum investment threshold is. It's a huge, huge problem. But Casey, let's say we're able to build this thing out of duct tape. Make that 250. I'm still not up to my cap rate. I still am not even at break even. And I'm building this out of, I don't know, found objects. So let's say I build a building that somehow has no corridors and I give up on all amenities. It would change that to 90%, which has never happened. But so here I'm at least above the cap rate, but I'm still more than a full point away from my minimum investment threshold. So Casey, on the OpEx, let's say we run this whole thing with free robots, right? I don't know. We haven't quite gotten there yet, but let's say it's 20%, right? So now I'm getting close. So I've got my robots. I've got no amenities and no corridors. I'm building it out of duct tape and twine, but I'm still not there. I'm still, 3 points off of a minimum investment threshold. So let's take that $20 million, Casey, of residual land value. Let's make that a 0. So somebody gave me the land. Aunt Maribel really wanted me to build apartments. Now I can build this thing. So, and Casey, if you leave the land value there and you put the 30% back up at the top in the G17, yeah, that's normal. Put the 80% back here for me, which is normal. Again, not inaggressive, and put the 300 back here, which is again not steel, glass, concrete high rise. That's 325, 350. But this is a typical 4 or 5 story stick, right? So now I'm back with free land, standard, non-crazy numbers above, free land, just fell in our lap somehow. I'm still not anywhere. I'm still full point and 1.1 points, 1.2 points lower than my minimum investment threshold. So hopefully that helps or hurts. I don't know.
Yeah, so what I took away from that briefly is costs a lot to build stuff. While you're building it, before anybody can live in it, you got to pay a bunch of people to carry it, right? Yep. Not only whatever you paid for the land, but also construction contractors and suppliers and architects and engineers and all the rest of that. And then once you've built it, you still got to operate it, which is taking a big chunk out of the money that's the rent that's coming in that otherwise has to go to debt service or to pay some investors back.
Right. The only other thing, Casey, that I didn't mention was just looking at that, and this is the same basic, very expensive apartments that we had in the other pro forma. But just to look at it, if it's a 25% of income, That's those studio apartments. You're going to make $95,000 a year to live in a studio apartment in this building. You have to make $200,000+ a year just to live in a 3-bed. So if you got kids, you need to be making a fortune to live in this building. And all of that was part of this too. So we could take this and you could lower this rate to 50% or something, and it would obviously, actually, Casey, real quick, type in 50% here. You see this one? So dropping it to, I'll say a much more reasonable, 76,000 for a studio, 94 for a 1-bed. I don't know if that's reasonable or not, but that's a much better, maybe more realistic, much bigger part of the market. But I'm a full point, almost a full point below my cap rate. I'm losing a lot of money, tens of millions of dollars on this job. Yeah, sorry. Casey, can we take some questions? You want to wait?
Let's, I hate to do this because there's a lot to unpack in what you said, but I think that some of this will become more clear as we hear from the other presenters. So let's come back for questions once we've heard definitely from Alan, and maybe Zach will also have arrived by then. But let's turn it over to Alan. Thank you for that. That's a lot to digest. But.
No good news.
Good morning. So not an easy act to follow, Matt. That was a beautiful, detailed articulation of all the challenges that are behind the newspaper articles that we all hear about why people aren't building in Montgomery County. And Casey's intention here, which I think was executed very nicely, was to talk about the stuff that you usually don't talk about at the Affordable Housing Conference or the other sessions where we get together to talk about affordable housing. My presentation will be a little bit more conventional, but what we're going to do here in the next couple of minutes, the few that Matt left me, is we're going to step through the looking glass. So I've got the same costs, hard costs, soft costs, operating expenses, land, and we're trying to provide the same quality of housing in the same operating environment to serve the same population at a fraction of the rents. So everything that Matt put out as a hypothetical, almost without exception, we're going to talk about how at a specific example that's a reflection of so many of the folks in the room who participated in this, is that Affordable Homes and Communities did a project at the corner of Randolph and Veers Mill, just 2 miles from where we're sitting, and I'm going to talk us through that, and then we will also sort of halt hard on the financing page and talk about why there's such significant differences in every single line item there versus what Matt just took us through. And then I'm going to figure out how we marry up with Matt and make his deals work. All right, if we could, please, Casey. Affordable Homes and Communities, we've been doing this for about 50 years. We're based over in Arlington, but have a strong presence in Montgomery County, which is my home county, Kennedy High School. So it's always fun to be home. We've got almost 9,000 units at this point, either developed, owned, under construction, or about to be acquired. We focus not just on putting a roof over people's heads, but ensuring that people have a platform for transformation where they are living in an environment where they can thrive and succeed, knowing not only that they have a home that they will be able to afford to live in without an end date, without worrying about that next increase, also with, in most of our communities, site-based resident services. Next slide. So this is what we look to do with our residents, leading with what the people at our communities are looking for rather than telling them what they need. What we have found is that for the populations that we serve, which are the 60% AMI and below residents of the county, who I think for the most part are approximately 80% Black and brown, education and youth development, economic mobility, health and wellness, particularly for our seniors, and then community building and engagement, each of which sounds a little bit amorphous, but when you drill down into the programming and you have after-school teen tutoring and you have kids succeeding in middle school who then go to high school, our career and college readiness program has sent, I don't know how many hundreds of kids, who are the first in their family, many immigrant families, to college. And every year we have a big celebration and everybody wears their jersey and we talk about how many millions of dollars of scholarships those kids were awarded. And we fund at the organizational level with the resources that we generate as a company, and I've teed up a couple of folks to try to ask a question about that, please do, a career and college readiness counselor who on the payroll of a not-for-profit is focused on the success of the residents. Before Casey tells me to move on, let me get to the rest of it. Next, please. So this is fun. For the folks that have been around for a while, this building in the center is the original Roundhouse Theater. It was also Gabe Albernaz's home of the Department of Recreation for a number of years. And it is a 6-acre, relatively flat site sitting at a wonderful high opportunity location just here at the corner of Veers Mill and Randolph. With access to good schools. It's at the intersection of 2 bus rapid transit lines. Just a marvelous opportunity. So back in 2019, and if we do the math real quick, it's basically 2025, and we just got the first certificate of occupancy. So as we think about rates of return and the number of years that we're accruing 17% interest on our mezz debt, this is not a market rate deal, but nonetheless, we're going to get it done. Mr. Elrich and his team put this land out with a request for proposals. There wasn't a whole lot of guidance other than we're looking for affordable. But it was clear from county policy that there was an opportunity here with the free land that Matt said was mythical in most cases. In this case, it was actually going to be real. So the question was, can you pay for the land or do you need it for free? So we partnered up with Habitat. Any of my Habitat friends here? Yes, Ron's here somewhere. Hello, sir. And we came up with an interesting initiative that not only responded to the need for affordable rental housing, but also affordable home ownership so that some of the families of the community could be building intergenerational wealth. Completely different concept. So we put together 2 proposals, one that said we can do all 60% AMI, we can give you the basics, the nuts and the bolts, and we can pay you a couple $1,000,000 for the land. And then we swung for the fences, and we offered a proposal that offered deep affordability without ongoing operating subsidies, on-site childcare, on-site resident services. Almost 50% of the units are 3- and 4-bedroom new construction apartments, which are unheard of and haven't been built in the county, I don't know, I'll say in generations, although I see park and planning people here that could correct me. The last time someone built a 4-bedroom apartment was quite a ways back. So we put together this proposal. We slapped a $14 million request of the county onto it, saying that if you could come up with these resources, we could come up with the rest to make this a reality. I sort of sent it in, and it went through a process. We were vetted heavily. I think that the home ownership, coupled with the service, coupled with the deep affordability, carried the day, and at the end, we got the nod to proceed on this deal. So starting 5 years ago, we jumped into a redevelopment. Next slide. Casey wanted us to focus on the challenges, not the successes. So without even thinking very hard, what's the development program? How do you get through the zoning process? Pleased to be sitting here with that zoning approval in my pocket, having worked very closely with, I think it was Team 1, fabulous experience. Legal structuring and a joint venture, because not only do we have all the complexities of affordable housing, we now have a partnership with a company that's doing another business in the home ownership. Financing, again, that we'll talk about, the supply chain that you guys heard about conceptually and read about in the newspaper, impacted by the pandemic, translated for us to there are no electrical switch gears and panels and things. You couldn't turn anything on. So we dealt with that. Interest rates, relatively speaking, have doubled. We'll take a quick look at that. And then the permitting and inspection process, not knowing every face in the room, but it's good but could be better. There were times where we just got stalled waiting for clarifications of things that never should have held us up. So here was the concept. Let's not only explore the idea of affordable home ownership combined with rental, but we also wanted to address the cost of building new construction affordable housing. The typical elevator building, and Matt gave us a lot of the parameters that are applicable here, with 85% efficiency and X 1,000 gross square feet per unit, many of the same metrics that the market rate folks guys use on the design side, a little different on the financing side. So what we concocted is a concept where we did a bigger building that represented your typical elevator, public spaces, structured parking, meaning a parking garage and concrete down below a stick building. And then in the orange, we did a smaller 34-unit building with tuck under parking, sort of an exploration of a different cost paradigm because we reduced the costs. And then lastly, those 6 buildings in the middle around the Green Park, all of which you'll see in a second, are 12-story walk-ups, garden-style apartments, 3 stories, 4 units per floor, 12-unit buildings. And because we had the land and we were mission-focused here, this is where we've got the majority of our 2, 3, and 4-bedroom apartments. The 2 in pink are Ron's affordable homeownership condominiums. And there's a whole legal financing and structural considerations that go on beneath that. To the bottom there, completing the single-family neighborhood, we have 3 Habitat homeownership units where using their, I'll try to get this right, using the traditional sweat equity model, the lower income, moderate income home buyers are participating in the construction of their own home. Some of us in the room have had the privilege of getting out there and doing a build day. If you're interested, again, Ron or the website, there's lots and lots of volunteer opportunities, whether you want to swing a hammer or you're better at writing a check, whatever it might be. Lots of ways. Please tell Jeff I gave him the plug. Okay, next, please. One of the ideas of being able to incorporate the home ownership here was Habitat, if I can try to contextualize for them, is doing things on a small scale basis means you have a sort of denominator of 1. If you need to put in a new water line and you're creating 1 unit, it's very expensive. If you're doing the 24 condominiums that Habitat was doing, it's still fairly expensive. If you are part of a 195-unit integrated community going through with a single site plan, with a unified utility plan, all of a sudden you're amortizing those costs across all the units in such a way that the homes were able to be affordable using Habitat's traditional financing model, very different from the tax credits. So wonderful synergies created there and something that we would hope to replicate in the future. Casey? Is that how you pictured it? On your way out, if you have a couple of extra minutes, please drive up Veers Mill, make a right on Randolph, and there she is. We have just delivered a couple of the 12-unit buildings. By Christmas, we hope to have people living in them. The other buildings will come online in January, and we expect to be fully leased and have hopefully the whole county council and executive and DHCA and the state and all the people who participated in this, in making this happen, cutting ribbons as soon as the flowers come up. Speaking of flowers, we've actually branded the community Allium Place. Allium is some sort of a local flower. It's very pretty, and you'll see in the marketing that we've got sort of a little graphic that picks up that theme. So we'll start to talk about Allium Place. As you can see, we incorporated everything but the kitchen sink in terms of policy priorities here. I've talked about the larger units, the park running down the middle, our landscaping group, Trini Rodriguez did a beautiful job. We've got sort of a multi-sectional space where you're going to be able to do passive activities and active activities. We're going to tie into the internet. So when I talked about the importance of not just providing housing, we're actually going to have folks in committed affordable housing with on-site resident services, access to transportation, access to childcare, accessing the internet at the same speeds that the rest of us are privileged to. At very low cost. We're fully electric, consistent with the county's guidance moving in that direction, and I've mentioned the transit. These AMIs, area median incomes, I don't have the current statistics in my head. We have a couple of folks in the room that might know them right off the top of the head, but at 60% AMI, 60% of the area median income, one of my favorite things to do here, does anybody know the area median income for a household of 4 in the Washington metropolitan statistical area who isn't paid to know it? 157. That sounds like somebody who knows. Yes, it is right in that vicinity, and we're due for an increase in May. So the idea of affordable housing is that if we go back to Matt's presentation, he was talking about how much you have to earn to be able to afford to live in market rate housing. So it's the inverse. In affordable housing, you have to earn less than 60% of the area median income. So grab your calculator or don't, pay attention to me, please. 157,000 times 0.6 gives you your maximum allowable income. You divide by 12, multiply by 0.3, and that gives you a monthly rent that consumes 30% of your gross household income. Because rents in our area are so high, we typically charge the maximum allowable, which again is intended to serve folks at each of those different levels. So it's 60% AMI for, again, a household of 4. It scales up and down. I think we're talking about a household income about $90,000, and it reduces dramatically in the 30% AMI range. We're going to be able to house people earning $28,000. It's really going to be quite a community that's going to allow all of our bus drivers and service professionals and tech folks and everyone who supports the rest of us in our daily living to remain integrated in the community, benefit from all the amenities of living here. Casey? Here's where the rubber hit the road. The pandemic was not conceptual. I think did you also say 20% cost increases? Yeah. It's just inconceivable. In a new construction project, plus or minus 70% of all your costs in an affordable scenario are hard costs. As Matt said, that's your sticks and your bricks and, what'd you say, stuff you could put in your trunk and walk away with? That's the soft cut. Oh, you gotcha. Gotcha. All right. We went up 20%, and we'll see the numbers in just a second so you can get the order of magnitude, but it's like a $60 million construction cost. This is not the gallon of milk that had so much of our country perhaps in a tizzy in the recent election, which is not my topic. But when you get an increase of that magnitude on a $60 million invoice, it blows things out of the water. Interest rates, we all read about them. Many of us were privileged to have fixed rate mortgages where we just sort of read about it. But when you're borrowing $30, $40, $50 million of construction money that floats at a spread, at a rate over the index, and it goes up by almost 4 points, 4%, hundreds of thousands of dollars added to our interest expense as well. Next. So here's what ours looks like. The idea was that Matt would show you the inner workings. I'm going to pretend we coordinated this. Matt's going to show you the inner workings of how you look at a deal from putting together the pro forma and then evaluating the capital that you need to make it financeable. In this instance, as I mentioned before, we've got all the same challenges. An affordable community is no different except for the folks that we serve in the housing. So what we've got here, let me start in the proposed column, and then we can sort of watch what we closed on. So our financing in this case, which is basically the mortgage, reflects the amount of revenue that we bring in minus our operating expenses, same as Matt's. He calls it a concierge, we call it resident services, same result. When we were looking at a $63 million transaction back in 2019, our pro forma, which was intended to be reasonably conservative, showed that we were able to put in place a $23 million, $24 million mortgage, about a third of the financing. This is not a session in which we're going to go deep on the low-income housing tax credit, but basically it is a tax offset where profitable corporations can invest in housing to meet their Community Reinvestment Act obligations, and it is, through a fairly complicated process, monetized so that we get cash as the developer. The tax credit investor gets a stream of tax write-offs on which they earn a return as well as get the regulatory benefit of complying with their CRA obligations. And in this case, we were able to turn that into $21 million we had estimated. Skipping for a second, we were fortunate to get support from the state. Initially, we were estimating that at the time they were offering up to $2.5 million per transaction. We thought that given the impact of our deal that we would be likely to get that. I'll talk about that in just a second. Ahcmc put in an investment, so we have some cash in the game. That's sort of one of the ways you show your partners that you are legit. And then we talked about the $14 million before. The Federal Home Loan Bank, we were fortunate to put in a competitive application. And again, we had checked so many boxes that on objective scoring, we were fortunate to win what at the time was a $500,000 award. And then the Maryland Energy Efficiency housing aid, let's go with that. We qualified for that as well, which related to the energy efficiency standards that we put into the deal. So we had a $63 million transaction. We ran into the buzzsaw of the pandemic, and as you can see, this is where it gets interesting. The supportable mortgage didn't really change. The impact has been primarily in short-term interest rates that have skyrocketed. Long-term interest rates, they went up a bit, but we had factored that in to a certain extent. By virtue of needing to spend so much more on construction, our tax credit equity went up. The state acknowledged the fact that costs were going up dramatically and generously stepped forward with a substantially larger loan. We still had the MIHA and the Federal Home Loan Bank money. We did have to account in a sort of a legal maneuver for the cost of the land to bring it into the transaction, so the $4.4 million wasn't actually cash. And then the big punchline is that the county executive, DHCA, saw the merits in the proposal, stuck with it, and added $10 million to what was already a generous allocation of the Housing Initiative Fund. So we've got practically a $24 million investment in there. As you can see, like we talked about before, out of 86 million, I didn't have a percentage column there, but a good 70% of that is your hard costs, your soft costs, as Matt said, design, engineering, et cetera. Much of the financing costs, while they do add up between the complex legal structuring and the fees for the this and the that and the other, construction loan, perm loan, tax credit equity, a lot of that is the construction period interest that's incurred while we're under construction. And then my favorite part, the development fee, $2.5 million. Matt wouldn't cross the street to look at this for $2.5 million. And then if you look up above, we've got a deferred fee, which again it's the way that the industry works, is that a portion of your fee that can't be paid in cash from the transaction gets deferred. So at the end of the day, after 5 years of work and salary and risk and all of the other things, again, understanding that that's the way the affordable industry works, but comparing it to what we just learned about the market rate industry, we will do all of this as a company, as Affordable Homes and Communities, hoping to earn $1 million. And the punchline to that is that while there is so much government participation here, we really only have about 25% of the transaction that is truly supportable financing. The rest of it is various degrees of funny money. So there is no backstop from the government in the event that something goes wrong. So that's another significant difference, is that MHP, True Ground, AHC, we are not government entities. We are private sector, not-for-profit businesses. We do this at risk. We sign guarantees, same types of completion guarantees, conversion to perm guarantees. We add tax credit guarantees and some other compliance guarantees that the market rate folks don't have. But again, it's an interesting question that I'd like to debate with folks in another forum, but we do need to make sure that we're also investing in the organizations that are able to undertake these transactions in partnership with all of the other governmental and private sector entities to do this. Anything else? There was our 5-year time frame. You got to get a sense there from the construction picture. I think that's a fairly recent one. Again, I encourage you to go by. I think you can drive through the site as of last week. Maybe not yet. Anything else? And this is why we do it. Here are some of our residents, from the graduates to the kids, and I think down bottom right we've got a habitat slide. So thank you very much. As time allows, I'd be glad to take questions.
Again, we want to try to defer some questions till the end because we want to make sure we get everybody a chance to get all their material out. Zach Marks has joined us from child care and weather-related delay. We've all been there. Although Tony made it all the way from, where'd you come from? Baltimore, yeah. Got a little tap in the bumper in her own neighborhood. So she wins the award for, you dealt with child care, but that's right, that's right. Well, thank you for coming, Zach. Let me fire up your presentation here. Yeah, so I think just by way of short transition rather than introduction of Zach's presentation, HOC's got a lot of favorable press, which I think it deserves for some really innovative ways to try to find some additional sources of cheaper money. And Zach is going to walk us through that. But I think, again, the theme here is not to accentuate the negative so much as just to remind everybody what are the constraints. So I read a New York Times story that made it sound like Zach had solved for the laws of gravity and physics and economics. And so I want to give Zach a chance to tell us what he has accomplished, what HOC has done, which they are rightly proud of and the county is proud of, but also what are the limits of your approaches. And with that, I'll hand it over to Zach.
Thank you, Casey. And yes, if all of that were true, I would have been here on time. So, I think I see a lot of familiar faces, so I won't spend a ton of time on sort of the overture as to who HOC is, but just really quickly for those who don't know, it's the fancy marketing name for the Housing Authority and Housing Finance Agency for Montgomery County, Maryland. So we are a governmental agency. Again, most people I think know Montgomery County, but really just highlighting that it is it's an expensive place to live, it's an expensive place to build, and it's an incredibly diverse community across socioeconomic status, race, profession, religion, and so forth. So it really is building in an urban environment in many ways, and it's HOC's job. It has been HOC's job for decades to try to solve affordable housing. That little riddle. So go to the next slide, please. One of the most important things to understand about HOC is that it is an incredibly powerful, strong organization. It is not your typical housing authority. It is not your typical housing finance agency. The combination of the two, in fact, lends itself to some of that, robustness. But HOC has been, started out as a pure play public housing authority many decades ago, but it has not been that for a long time. We do provide the most units at 30% and below of anybody else, but HOC has been doing much, much more and has been constantly trying to innovate because of the limitations that Alan emphasized. And so we do this presentation a lot. We get asked by jurisdictions across the country to present on the fund, but I'm going to present it with a little bit of a different spin today given the topic. So, but one of the things I really, like the premise here that's really important is that HOC is actually a very strong, well-resourced organization. It has a history of sophisticated development, not just in the last 10 or 15 years, but over many decades. And so it has been innovating for a long time. So is the county. And so we sort of go from being first to last to first all the time around innovating in the affordable housing space. But really important here just to start with this idea. And the other idea that I want to put forth just as sort of a framework for what I'll show you, because it gets really technical and maybe sleepy in a hurry. But the other thing is this is a fund. The Housing Production Fund was created to meet the supply issue in this county. We haven't met our housing goals in a particular year, I don't know, in a long time, ever, sometimes probably not in the last couple of decades. We just don't meet them. So where this idea came from was that the council back in around 2018, 2019, was engaged with the Metro Washington Council of Governments around trying to decide how much supply do we really need. And so we really worked from what the council had done, what planning had done around really exploring the idea of supply and inventory. And we don't hit it. We set our goals in 2019, it's something like 3,500 units a year, and we've never done it since. And so the problem here is that, and it's really great, coming behind Matt and Alan, because they give you a sense of what the private sector is doing to try to meet supply, what the nonprofit sector, the LIHTC sector, the low-income housing tax credit development sector is doing to meet housing supply. And they're doing what they can, right? They're taking their resources and they're putting them to work in this county. And every year it isn't enough. HOC, oddly enough, has been sort of playing in both spaces throughout that same period of time. So HOC generally builds what's called a mixed income development, which tends to be deals that are large and look like market rate housing, but have an elevated level of affordability in it that deliver the kinds of affordability that that Allen's projects do. And so we've been riding along all the time. And so the framework I just want to provide here is that the main issue that I see that frames this whole discussion is that the goal really isn't the delivery of supply, that in all these different bureaucracies, HOC included, you just don't yet have it where the government and these bureaucracies really are trying to deliver supply. If they were, we'd all be doing things differently. This was an idea that came along toward that end, but to be very clear, HOC is doing a lot, and we get, it's fun to be in the paper. It's fun to get a call from your mom who saw your name in the paper, like neat. But at the end of the day, this was just one idea, a fairly simple one that had some pretty profound implications. But it's really geared around this idea that it's not really individual people at HOC or planning or council or anywhere throughout government that are the issues. It's that we just don't yet totally fully believe it's our job to put as much supply on the ground as necessary to meet the housing needs. So I just want to be really clear as we walk through this. That's what this is really all about, is starting to turn some of these resources in those directions. So we created the Housing Production Fund in 2021, sort of in the middle of the pandemic. So we designed it to sort of meet a few different goals. One, it needed to be very, very light on appropriations, because this was back in the days where it wasn't yet clear whether we would have any government or money or anything or budgets or earth or something. So you couldn't ask people for a lot of money back then. So we designed this program to be very light on appropriations, but we also wanted to be very ambitious about what we were trying to do, because we had a council member come up to us and say, hey, I want to build an affordable housing platform. I'm happy to make a leg of the stool. Anything you want, you just have to tell us. And so we acted like we had a bunch of ideas ready to go, and then we went back and we really thought about it. One of our most expensive sources of capital is private equity. So really what goes into the conventional real estate model. So what the Housing Production Fund is designed to do is actually really simple for a change, because most of the time affordable housing finance is super complicated. So what it's designed to do is replace private equity in the conventional market rate model of real estate development in the US. And the reason we're able to replace it is because we have access to this really cheap source of capital as a government agency and as a government, as county government, and that is municipal finance. So then if it's that easy, if you just always had this source of municipal finance sitting around, why didn't you do that before? Which is a fair question, but B, it's because the idea that government could participate in a space that is highly profitable is not the first thing we think about when we think about government at any level in America as Americans. And so the hard part about the production fund is not the financing. It's actually getting Americans to wrap their mind around the idea that government can be competent and play in a profitable space and use that profit toward mission, right? So we'll go to the next slide. I will spend just a couple of seconds here on this because this is the rabbit hole. Happy to go down with anybody. I live down there, so happy to show you around, but I also want to make sure that we stay with the really kind of interesting qualitative stuff. But this is the cool things to take away from this. How did we make it so inexpensive? So because of the county's AAA rating and $7 billion budget, they are able to the principal and interest on the bonds that created the $100 million fund, right? So the county didn't give us $100 million. That's not how we did it, right? We created a $100 million fund by selling $100 million in bonds. And as you know, when you sell bonds, the way you pay those back is with principal and interest. And these are 20-year bonds. And so what the county actually agreed to, the council, the support they gave us, tremendous, and to do it with such speed was tremendous, was to give HOC the equivalent of 20 years every year, 20 years of principal and interest to pay back the 20-year bond that created the fund. At today's rates, that would cost the county about $7.7 million a year, gross, right? On a $7 billion budget, right? So you get a $100 million fund, $7.7 million a year. And, but here's where it gets neat. Once we put the $100 million into the fund, that fund starts loaning to our projects, right? Our new developments. We charge our projects $5 million. This will be the last of the math, I swear. So 5% on 100 million, I am reliably informed, is $5 million a year. We send that $5 million back to the county. So the county's actual cost is really 7.7 million minus 5 million, which is 2.7 million a year for 20 years. For 20 years. After 20 years, the bond is paid off, and then the revolving fund is actually free, does not cost anything anymore, and still exists. And so that is a tremendously light appropriation for something that has this kind of impact. So the real takeaways here is that this revolving nature and the mixed income nature, because we can pay 5% on our money because we have market rate units. That, you know, Alan's doing 100% mission, right? He doesn't have those market rate units. So these market rate units, you can see the power of that cross subsidization. Go to the next slide. So again, sometimes it was really taking two worlds that do not really talk to each other or spend any time thinking about the other and putting them together. That is really how you can, you know, best frame how this production fund works. Most of the time, in the affordable housing space, when I'm doing these presentations at affordable housing, you know, seminars and so forth, everybody goes to work every day to think about that model on the right. That's Alan's model, right? That's the tax credit model. That is the model that's delivered so much affordable housing across the country, but it's also the model where we use up every single dollar every year, and we're getting what we're getting. It's very high quality, but that's it. And there's really, we've done 8 million things to try to stretch it. You can see the level of support that the county provides to these deals. It's a tremendous level of support. And, you know, we get what we get. We're still missing our housing goals every year, right? And then on the left is really the market rate model. And what we did is, and so instead of thinking about the production fund as funding to support the model on the right, the traditional affordable housing LIHTC model, it's really to kick the private equity out of the left side and put in the housing production fund. And really the best part about this from the council's perspective was, if we give HOC this fund, and now HOC has this fund to replace private equity, HOC becomes the owner of these transactions instead of private equity. That is huge. It's huge for a whole bunch of reasons. But primarily, it is much easier to set the policy in your buildings. You only want to raise rents 3% on your tenants every year? Guess who gets to decide that? The owner, right? You want to make sure everybody has access to resident services, even at a budgetary cost of the deal. Guess who decides that? The owner, right? Eviction policies, the owner, right? And so all of these things are possible because HOC is able to be the owner. Now, HOC's been building transactions like the one on the left throughout those decades, like I mentioned. So what this was really the answer to was the question that was actually asked by this council member, which is, I love the Lindley. Go down to Chevy Chase Lake, there's a building called the Lindley, right? It's beautiful, still beautiful. And it's a mixed income transaction, 60% market rate, 20% at 100% AMI, 20% at 50% AMI, 200 unit building. And the council member said, how do I get you to build 10 of these? And I said, besides the heart attack, like the main way to do it is it costs a lot of equity. You need to write a fairly significant check. It may be hard to see on this exhibit here, but generally speaking, your construction loan is only going to give you about 60 cents on the dollar. And on a 200, 300, 400 unit transaction, you know, you're talking these days about maybe a $200 million transaction. So what's 20, 30% of that? That's the check you have to be able to write. That's why the $100 million fund is so powerful, because now HOC can step in and write that check. We only charge at 5%. You heard what private equity charges, and that's a huge delta. And so that percentage that private equity charges also, by the way, is the reason why rents have to go up so much every year. Because developers are only responding to their incentives, which is to get their equity paid. So by putting us in at 5%, you take all that stress off the building of needing to jam rents every year. You're not paying your rent, get out, right? So this is a really powerful idea that it's really, and HOC has embodied this for many decades, but this was really about how do we do this a whole bunch more, because we keep missing our housing goals. We'll go to the next slide. One of the other really effective things, I certainly think the council members felt this way. The program was created in March of 21. The first building opened in June of 23. Now, I don't want Casey to panic and think that, this is supposed to be about how it's hard to get stuff open really quickly. It is definitely hard to get stuff open really quickly, 100%. But what was great here, and it goes direct to hitting our housing goals, is that the Laureate, we didn't design it. We didn't develop it. We weren't even in the deal until the last year before it closed. This deal was stuck. It was fully entitled. The county was providing its support. This is being done on former county land. And it still was stuck, right? In the same way, some of the same economic environment that we're dealing with today that Allen faced as construction costs ran up in a way. And how do you get the deal closed? Well, they actually couldn't get it closed. So this was a 268-unit property that would not have been built starting in 2021. It would have sat until financing improved, and eventually it worked as a market rate deal, and then it moved forward. But those delays mean no homes, right? I mean, we continue to miss our housing goals. People don't have units to move into, or they're paying 50% of their income to get into those units. So what was great about this is HOC was able to show up and be like, we would love to finance your deal, and actually it works with our money because we have a different financing approach. So we can start right now, and the only thing you have to do is you have to give us all the ownership, and we have to increase affordability to 30% of the entire units. How happy with that do you think the developers were? They were thrilled. Do you know why they were thrilled? Because they spent $5 million entitling this deal, and they couldn't get that $5 million back until the deal was financed and closed. So the developers were thrilled. You know why else they were thrilled? They were going to be the owner of the building anyway. It was going to be the private equity, right? And so instead, they get the lovely people at HOC are now their partners and the owners in this transaction, right? We also bring a ton of other financing tools to the table, but this is for another day when you're having trouble sleeping. But what was really great about this was that this is how fast we were able to make an impact. As soon as that dollar was given to us, we were able to go right to work. And I want to be really clear about why that happened. It's because this was done at the local level. We've had plenty of discussions at the federal level. There's lots of ways the federal government can help. But I think we all know that federal money comes with strings attached that makes everything slow down, right? It's like the sloth running the DMV in that kids movie. Next slide, please. So just to be clear about the kinds of developments that HOC is financing with this money, these are very, very large developments. So you may say to yourself, well, Alan's doing 100%, Zach, you're only doing 30%, so not that great. And what we want to be clear about here is these developments are by and large not taking resources from the deals that Alan's trying to do. That is really important. We cannot expand our production if all we're doing is just trading back and forth the same dollar. So by and large, these transactions are not using the same resources. So these are transactions that are 300, 400 units in size. And so 30% of that number is 90, 100, 120 in terms of affordable units. So what you are basically getting is a LIHTC deal without having to have used the LIHTC awards that are finite and we use every year. And many of the other associated resources, the money that the county had to put into Allen's transaction, we didn't have to go to that same source because otherwise we would have. So it was about creating this third channel to hit supply that doesn't cannibalize the other two elements of this. So this is, again, not a replacement for any of the good work that's going on here, either in the private sector, on the for-profit side, or on the nonprofit side. There had to be an additional way if we were going to meet our housing goals. And then I think, let's see. And again, you can see the mix. It's almost like blending the two presentations, right? So again, because we're the owner, we're able to do all of these things. Nobody can tell my commission what to do with its properties. It can do all of these things. So it's affordable forever. We can work with families. They get access to our resident services, which is a very big, that's a whole division at HOC with a ton of talented people. And we can also do other things. We can stack other goals on top of it that aren't even just housing. So one of the transactions you saw up there that just closed was Hillendale Gateway. It's the first 2 multifamily rental passive house deals in the state. One of the buildings is net zero, which in California, they laugh at us for being so cute at this age, but out here, doing a net zero rental multifamily building is a big leap forward. So we stack that right on top of this platform. And so the commission is able to make decisions about those additional kinds of goals as well. And then probably the most important thing in terms of the sustainability is that this is now public equity that's being built. And I'll just finish here. So, you know, if you own your home, or if you have thought about owning a home, you know, one of the reasons you might do that is over the course of time, you pay your mortgage and you build equity in that home, right? And then eventually that becomes home equity that you can use to do other things, or just no longer have a payment, right? Well, think about that idea, except HOC's homes that they own, right, are these huge Class A institutional grade properties. And so as the mortgage gets paid down, as the property appreciates, all of that equity belongs to, spoiler alert, HOC, right? So 20 years from now, HOC is gonna have 50% equity built up in very expensive, valuable buildings. And that value can't go anywhere else except into additional projects. So that 20-year bond gets paid off for the Housing Production Fund, and at the same time, HOC is building tremendous amounts of equity going forward that it can then refinance and use to build other transactions. So this is really enriching a government entity in a way that is very light on appropriations, but over time translates into a ton of financing power, which only allows HOC to do more and more in the future, which of course we have to meet those housing goals. So I know there's a few more slides, but that was a whole heck of a lot, so. Thanks.
Well, that's great, and I do want to get through everybody in time for questions, so. I want to turn now to Ed Barnett, who works on financing or helping finance a lot of these types of transactions from the state's view. And maybe Ed could tell us a little bit about how those programs work, and also maybe some of your reaction to what you've heard so far.
Yeah, I'd like to start with the reaction first. First of all, I want to congratulate HOC on the Housing Production Fund. And also, you know, we work very closely with Alan and his group on housing finance. And Alan, I'm going to take a look at one of your slides because you kind of illustrated some of the things that I want to talk about. But first of all, this Housing Production Fund, Zach, you talk about marrying the two worlds. But it also, I think you said it, but I want to stress it a little more. You're taking stress off of the state by doing what you do. The equity that you're using to build your housing reduction fund doesn't use low-income housing tax credits. It doesn't use the resources that we bring to the table that Alan uses in terms of subordinate financing. The fact that you are developing this without us in some ways, the state, means that there's more resources for the stuff that Alan does. And so everyone has their strengths and their niches of how they produce affordable housing. You're doing kind of both, which is wonderful. We don't do market rate housing, but we do see some market rate housing nearby, and it helps spur the market for the affordable that we do and makes the community richer. And so we appreciate all the work you do, particularly in areas that these two gentlemen work in. So I want to talk about the state of Maryland. I'm with the Department of Housing and Community Development. We are the financing arm of the state of Maryland for affordable rental housing, although we do single-family loans as well, but that's not my area. And, you know, I looked, last night I kind of looked at, what did we do in Montgomery County? You know, what happened in the last couple of years? And I took a look at the projects. There are about 10 of them, several of yours. That Hillendale project, bond financing, very involved in. Wonderful in terms of the energy efficiency. We were ecstatic when we saw your plans for that. It's like, oh, wow, my energy people like, oh, look at this, we're gonna do this. Wonderful, so great. I happened to be at the groundbreaking for the project you had, Alan. You talk about 3 and 4 bedroom units. The state of Maryland is so proud to be involved and provide financing for someone who's developing housing that's creating more than 1 and 2 bedroom units. There are a lot of families that need housing, and you know, 1 bedroom units don't don't really cut it. And so, wonderful work, Alan. We love what you've done there. So when I look at the projects, and let me back up a little bit. We provide subordinate financing, which means loans that are paid out of cash flow. So the numbers that these gentlemen were showing you, you know, they have a loan, they have their project costs, they have a loan. It throws off some cash flow at the end, and the financing that we provide says, you know, this money that you are borrowing from us is contingent on the availability of that cash flow. And so there are percentage, you know, calculations that are made, and the state of Maryland is going to get some of that cash flow. The borrower will get some of that. Many deals have to, I think Alan mentioned, deferred fee. The developer's putting money back into the deal in order to make it financially feasible. That gets paid out of cash flow as well. And so the state of Maryland is trying to find ways to create affordable housing by making the capital stack, as you mentioned, more easy, more manageable. One of Alan's slides, which I was going to point out, is that he showed, no, I think, yeah, that's it, yes. And I was going to say this today, you know, with affordable housing, you know, people say the capital stack is huge. Well, I counted, there were 9 sources of funds in that deal. How many sources of funds did you have in your deal? 2 or 3. Okay, 2 or 3, okay. So 9, that's an indication of how difficult it is, how hard it is to develop affordable housing. You need all these resources. When you look at this capital stack, you know, you went through the pandemic, of course, Alan, and if all the costs went way up, and that's why the closed project is so much different than what you proposed in the beginning. But one of the things I do want to say is that not only did the state of Maryland have to step up and provide more resources, but Montgomery County has stepped up in a big way. If you look at those numbers, you'll see the 14 went to $23 million. I'm just going to say the $14 million is a big lift for the county anyway. And so we've noticed in the last 3 or 5 years, the county has really put a lot of funds into deals, not just this county, but others around the state, but particularly this county has put a lot of funds into the deal to make it financially feasible. So I'm going to talk a little bit about some of the stuff I saw in the 10 projects that we finance or provide financing for in the past couple of years. You know, the average cost was like $44 million for a project in the last couple of years. We have 2 doors of financing that you can work with us with. One is, and it's all low-income housing tax credits, by the way. It's not what Zach was talking about. It's all low. It's that right side of his slide he was mentioning previously. It's all low-income housing tax credits. We have 2 doors. One is what we call our competitive round. You may have heard the 9% credits. Raise your hand if you've heard that before, so let me know. Okay, the 9% credits. We call it the competitive round because it's very competitive. We have more requests for resources than we have resources to provide financing for. And so to win that award of credits, it's a point score. We have criteria, you do this, you do that, you have low affordability, you get more points, you have larger bedroom units, you get more points. There are conceivably 200 points you can try to get to, but you can't actually do that. You have to pick and choose among those 200 possible points that you can get to in order to be awarded tax credits. We have a round every year. Once a year, generally in the spring, we'll have a submission deadline, and developers like Alan will come in and submit an application. We'll look at it, we'll score it, and the projects that score the most points, meaning they're doing all the things that the state is looking for, affordability, unit size, cost efficiency, energy efficiency, something we call lovable places, which means you have lots of nice amenities in the building. All those things score you points. The highest scoring projects win an award, and they off to the races to do development. So that's a once a year application cycle. And then we have what we call our bond program. This is the 4% credits. It's an ongoing program. There's no deadline, there's no application submission deadline you have to hit. We provide similar financing on a rolling basis, and we provide that financing on what we call a ready-to-proceed basis. We probably have like 120 projects in our pipeline right now. But of course, we don't have resources for 120 projects, and so whichever projects are ready first, get the resources. And so you go through our process, you look at, we get an application from you, we look at the costs, we look at your financing, we look at the development team, we make sure that you have a good team, because it's not for the faint-hearted. You're gonna have someone who really knows how to do this on your team. Not to cast aspersions against any lawyers, but your brother-in-law who is a child and family lawyer is not your attorney to work on a tax credit project. You're going to want someone who knows how to do tax credits and can advise you well. And same thing with contractors, same thing with architects, same thing with your property manager. And of course, the developer has to have some skill and understand how to develop properties, because we're going to evaluate the whole team. And then once the whole team is evaluated, those who are ready with a good team and can move forward with their projects will get the resources to develop the project. So just want to say a couple of things. I think I mentioned how much Montgomery County has put in the deal. You know, over those 10 projects, Montgomery County put like $8.6 million on average in the deal. That's huge. The state of Maryland, we're a state agency. We can't put all our resources in Montgomery County, but we do have limitations. And $3.3 million is what we put in those projects, those 10 projects over those 2 years. And so you can imagine what the county is doing, what the state is doing. Because the state has to accommodate the whole state, Montgomery County is taking care of the county itself. But the big thing here is their affordability, and that's what we're all about. All those projects, 20 some odd percent of those are serving people between 20 and 30% of area median income. And so that's a big deal for us. You know, for people who are making $28,000 or less than $28,000 a year can live in decent, well-constructed, energy-efficient housing. And of that group, you know, maybe 45% are in the 50, the 60% AMI level, maybe another 20 at 40, and the balance between 60 and 80% of AMI. And so you can see we get the strata of income for affordability for people who are renting in these properties, and it takes care of different types of families and people who live in the county across the state of Maryland, of course. And so you heard about construction, the cost. I think one of the things you wanted me to talk about is why does it cost so much? I think folks have already said it. You know, we had the pandemic, we had the supply chain issues, we had lumber costs go up, we had, who said switch gears? Switch gears you can't get. Delaying construction. If you delay construction, a contractor says, well, I thought I was going to start construction in December, and now I'm going to start construction in April. Well, prices for construction items don't stay static, they go up. I mean, look at your grocery bill. You're not paying the same for milk that you paid, you know, 5 years ago, or maybe even 5 weeks ago. And so costs go up, and so you know, it just makes things more expensive, and that puts more pressure on developers and the state agency to come up with ways and resources to help fill that gap. Some of that gap filling is done with, as I mentioned before, our subordinate financing. We'll put money into the deal. We'll take cash flow, a percentage of cash flow if there's cash flow available to that. We'll make sure or try to help the developer who has deferred some of their fee into the deal to get some of that fee paid back out of cash flow. And so that helps to make these deals financially feasible. And also the counties put money in the deal. We share cash flow with the county as well. And so all those things allow a couple of things to happen. One thing primarily to happen. If you take those funds and you're being repaid some of that in cash flow, what does that mean? That means that the money that Alan had put in its deferred fee gets paid back. It allows him to do probably his next deal or a portion of help paying for the next deal. It allows the state housing finance agency to use those resources to fund other deals. The same thing with the county. The county gets cash flow back. That money can be used to help develop more projects going forward. And so it's a cycle, and we try to make sure that it works well for projects. I just want to talk a little bit about something that is really important to the state of Maryland. It's important to all developers. It's not just the cost of building this housing. It's not just the financing. It's operating these properties. That's really, is that the hardest part, Alan, or Zach? Maybe the hardest or the most thing that you worry about the most. We look at operating expenses and we say, okay, what is going on here? Insurance costs are going up, big time. 25% increase in insurance in some places. You have real estate taxes. You may have utility costs are going up. All those things that are affecting your ability to make sure a project is financially feasible. Because when you think about those expenses, you have income, right? And you have debt, right? And so the income minus the expenses is what you have in terms of net operating income. That money has to be used, that money, the income minus the debt has to be able to pay, income minus expenses have to be able to pay off the debt. And so if your expenses go up, you have less money to pay that debt. And if you can't pay that debt, you probably can't do the deal. So we look at 20, 40-year performance to say, okay, what's the likelihood of a project being able to be financially feasible for a long period of time? Because you can imagine, unlike your 20-year mortgage, a lot of these bond deals have 40-year mortgages. And so a lender like Truist will say, okay, we have a loan in this deal. It's going to be for 40 years. We want to make sure that this thing works for 40 years. And so, and we're very keen on underwriting that as well. You wanted me to talk about something else, and I don't remember what that was. Was it our process or?
Well, allocation of tax credits, and that might be a good place to back up just for a second, because I know all of this just, it always confuses me, all this discussion of 4%, 9% tax credits, et cetera. I think the simple way I think about it is the federal government gives money for affordable housing, not by just appropriating money and handing, Alan or affordable housing developer a bag of cash, but they say, here's some tax credits are available that are administered by the state. There's a limited amount of tax credit to go around, and therefore the state has to decide how to allocate those among different projects in different parts of the state with different housing costs, different degrees of need in terms of affordable housing, and that means everybody's chasing around a small number of tax credits for a relatively large number of potential deals that could result in construction of affordable housing. So what I wanted to ask you, as the person who's sitting at the state, about that allocation, those allocation decisions, because I think a lot of people in Montgomery County have a little bit of a chip on our shoulder about the fact that sometimes it seems like the state is run like for Baltimore City, the Baltimore suburbs, places where people who live in Baltimore City and suburbs go on vacation, like the Eastern Shore, and they forget about us down here in the Washington suburbs, or they think the streets are paved with gold and we don't need any help. So I just want to give you a chance to disabuse us of any ideas we have about not getting our fair shake.
Sure. So let's break it into two pieces. One is the 9%, as I mentioned, the competitive round. That's probably more of what you're speaking to. We limit the amount of credits that can be awarded for a project in the 9% competitive round to $1.5 million of credits. Multiply that by 10, if you will, and that determines how much equity you're going to get in the deal. An investor will say, I'll pay you 86 cents on the dollar for that credit. Let's just use $1 million, and they're going to pay you 86 cents on the dollar for that credit, and that's the equity in the deal from the investor. In terms of where the projects are awarded credits, it's what I said previously. It's about scoring points. It really is. When you look at it, we have a program guide and a qualified allocation plan, which are all the rules of how we will allocate credits, what we expect in terms of construction quality, what we expect in terms of rules of how you're going to finance this deal, and so on. You score the points based on doing the things I mentioned previously. And so if your project is located in Montgomery County or Baltimore City or the Eastern Shore or Wacomico County, or wherever it might be, we're going to look at, okay, you've provided so much affordability in terms of 30%, 20%, whatever percent. If you're going to provide some market rate housing in that, that might help you a little bit in score. But the developer has to kind of mix and match the things that they can do. And really, as I mentioned, you can't score all 200 points. And sometimes you can't score points you might want because of your location. Your location may not avail you to the lower income AMI selection. If you live in a location and you get a market study, the market study says, most of the people that live here make 60% of AMI, right? We look at what we call capture rate. You have to capture so many of these people in order to make your project financially feasible. These people will come, is what I'm getting at. But if you're in a location with 60% AMI as the majority of the folks, then you're probably not going to try to do as many lower income, because maybe the folks are not there who might rent there, and vice versa. And so you may not, maybe if your population is lower, then you may not do as many 60% AMI units because there may not be enough residents in that location that will come and rent at your property. And so depending on where you live, or depending on what your goals are as a developer, what populations you want to serve, you have to kind of say, okay, does this fit where I'm building? And so again, you look at the scoring and how you might score. Maybe you don't need 4-bedroom units in this location. And so therefore you're not going to get points for it. Maybe that doesn't work for you. So you're going to really do a market analysis. The developer's going to do a market analysis and say, okay, this makes sense for this location, and then figure out, can I finance this? And then they go and figure out where the resources may come from in order to make the project. I hope that's helpful. On the bond side, and the point score, there's a minimum point score of 90 points. If you're doing what we call a risk sharing, which is a type of bond financing, it's 93 points. I haven't seen anyone, it's kind of hard not to score 90 points. I think some people are really trying. We see some applications that are trying not to do that. But it's kind of hard not to score 90 points on a bond transaction. And so those deals are not having issues. They're not competing against the 9%, which has a limited $1.5 million of credits. On the bond side, the credit is based on the cost of the project, what's eligible for credits, and we don't limit how much credit you can get on a bond transaction. So to say all that, in some locations, particularly higher income locations, you're going to see more bond transactions than you might see other 9% transactions, just for that reason. Because if the incomes are higher, then you can pay more debt service because you have the income. You're not worried about trying to have expenses that are running the deal, or you may not have, you have more income, and so you can make it work better. And so we do a lot of bond deals in Montgomery County. We do some 9%. I think Alan's deal was a twinning deal, and so it was a combination of the 9 and the 4. We kind of marry those two together. If you do that, it helps your scoring, and so you can score more points. And some developer says, oh, well, let's try to do a twinning deal, because now I can get the lower income residents served on the 9% deal. I can get the higher income folks served on the bond deal. I can marry the two and serve both populations. And then you get more points for having done that. And so that's somewhat of a solution for some developers. It doesn't work for everyone, but if you can find that sweet spot, that's what developers are doing. Hope that helps.
Yes, thank you. Now, last but not least, we have Tony Davis-Spivey, who's going to talk to us a little bit about programs that are available to help people who are in need of affordable housing get into a home. And I think probably to a lot of people, what happens before they walk into a lender probably sounds like, Charlie Brown's parents, just a lot of you know, wah about all this stuff about 4% and 9% and mezzanine financing and what it costs Matt to, you know, deal with his investment committee. When you're a person who just wants a place to live and you walk into a bank, what tools are available, what programs are available, and what are the limits of that in terms of what you can do to help people out when they're trying to get into an apartment or a home? Tony.
Good morning. So sitting here and listening to my fellows here, I said to Alan, I said, you know, this is like, you guys are at this at high level. And for me, I'm grassroots. I am sitting in on the workshops on Saturdays and the evenings with the first-time home buyers. I'm talking to the client who has the student loan debt. I'm talking to the person that has the housing choice voucher. I'm talking to the person that has just $3,000 and, you know, they've got to be in a certain community because of a school district, and we're trying to figure out based on their income and the price of the home, and they want to be in this county or this city, how we're going to make this work based on where they are, their income limit with, is it 80% AMI or 100% AMI or 120% AMI. And so, you know, one of the I guess, the challenges starts for me. This is from my perspective, from my seat in the bleachers. I think that if we all in our own way could start with just even our school systems, we have to educate. We need financial literacy in our secondary school system. We need to start there, because what happens is when they get to us, the damage is already done. They don't know how to manage their checking and their savings and their credit card and everything that happens before they even get to us on how to making the right financial decisions for themselves and their families before they get to that home ownership opportunity. In doing a budget, the housing counseling agencies do a great job in educating people about the process and setting up a budget to know what that's going to look like. But sometimes those expectations are not real. You made a comment about the insurance costs. Ironically, because you said it was a 25% increase? Okay, I beg to differ. Personally speaking, I've experienced more than that. And Sunday afternoon, I received an email from a client that I closed last November. I tried to create a open door policy with my clients that I'm here, as long as the guy has breath in my body, I'm always gonna be here for you, reach out. And so he reached out because his mortgage payment went up. And I took a look at it first thing yesterday morning, and one of the first things I noticed was that his insurance premium went up $611 from when he closed. So he closed at $1,296 a year, his premium is now $1,907, and 9 times out of 10, he didn't even look at his notice because it's in my escrow, the mortgage company has it. So I think that, I know for myself, I've taken a personal task on, and I think for those of you, I don't know what everyone does in this room, if any of you are lenders, if you're realtors, or just in your space, I do post-closing calls now with my clients. So 2 to 3 months after they close, I'm calling them up. I'm like, okay, we're doing a meeting, because we educate them up until getting the keys, and then we're like, see ya. And they don't know what to do. So we really need to look at arming our people with more education about how to manage those increasing insurance costs. We also need to look at some of the challenges with property tax bills. I'm not very familiar with Montgomery County, but I can speak to what we have going on, is particularly in Baltimore City. We have a very robust flipping environment. So material costs, you all talked about that. I deal with that a lot, because we have investors who are coming in and they're picking up these properties at a lower cost, but they have to take into consideration their hard costs and their soft costs of getting that home fixed up and back on the market. And now these homes that were at one point maybe more affordable are not as affordable for the clients. So when a client does pick up the phone and call me, and they are expressing their desire to be in a certain community, I have to, one is I'm always looking for, where's the money? And I, basically explained to them, looking at federal funds under Federal Home Loan Bank, state funds under Maryland Mortgage Program, and then the local jurisdictions as far as like Baltimore City, Baltimore County, Hartford, Howard, Montgomery, Prince George's County, because I've worked with all these different programs. But they all have, and I can even speak to this even through our footprint, because in my role, there are 40 of us at Truist that are community mortgage specialists. And so the CMS team, although we are loan officers, we are loan officers that are specialists. So it's like I would say, like a doctor, especially you have an eye doctor. So we all in our respective footprints are experiencing the same challenges, in that the AMI limits that are set by HUD or based off of HUD numbers are not in alignment with the price range of homes. And that has been an ongoing problem as long as I can remember, my 37 years being in the business. And I don't know what or if anything can actually correct that. To be honest with you, because like I sit there and I went, okay, well, if we throw more money at the problem, but the thing is that that money has to come from somewhere, and people are making more money to be able to afford their homes than the income that they make throws them where they're over the limit. So then they can't get the help. And then it's hard for them to save because of increased costs of insurance, even your car insurance premiums. Everybody else's car insurance gone up? Mine's gone up. Yeah, look. So, you have increase in insurance premiums, you have increase in food costs, increase in daycare. So it's like, how are we handling these things? And so that's why I led with, I think we need to start with educating, because I don't think that we've been giving our population the tools on how to maneuver when you run into these problems with things are more expensive. The other thing is, I think we're dealing with the dynamic of societal changes. I grew up in an era where, it was nothing for 2 or 3 generations to be in a household. Any of us ever, it's now everybody wants to be independent, or that you want to make that, you take a step back to spring forward. So you go ahead and you move home with mom and dad, or you have a roommate so you can help to save. So I think educating our people and broadening their mindset of how they're going to get to that goal and to position themselves is one piece of it, one piece. As far as the programs are concerned, as I said, for myself, I tell my clients, if there's money to be had, if you want it, we're gonna go get it. So I don't have a problem. I just closed Friday. We were supposed to have 6 down payment assistance programs, but the client kind of messed up on me, so we only had 5. But we ended up with $40,000 in assistance to help, which, use that to leverage reducing the loan amount. That's the whole point. Bringing the loan amount down, which helps bring the payment down. And in the case where you can, where I try as much as I can, because the PMI works out to be lower, and getting them into a conventional loan product, because the lower the loan to value, the lower the PMI premium, the lower the payment. So understanding how that all works together. The other thing is, again, like I said, just being, happy about the fact that I'm able to stack those programs together. But the challenge is funding, how long the funding lasts. Sometimes people hit it right at that arc where everything has money, and then it runs out, or it runs out in the middle of a transaction, which is not fun when you're trying to figure out how you can pivot. And so when you work in this space, you really do have to have your finger on the pulse of what's happening with the different incentive programs. Some, like Maryland Mortgage Program, always has money. Federal Home Loan Bank runs out. The local programs run out, and they run out a certain time of season. And it's, again, in having those relationships and accesses to those systems to keep your finger on the pulse of where the funding is, what's available, and how you can marry it together. I think that in some cases, too, there are some limitations that make it more challenging with the underwriting criteria. And I'm not saying I'm not an advocate at all. I don't, they allow it, I don't like it. Personally, I just think it's crazy that you allow a 50% debt ratio or 55% debt ratio because this is on gross. It's like, I'm looking at numbers going, I don't even want that payment, and I make more money than that. But there are some restrictions that they're so confining that they don't even match up with from the local programs. Like there's some where they have the housing expense can't be more than 37%. But yet you have HUD, VA, Fannie, Freddie saying something different and getting them to match up. So usually what ends up happening between the ratio requirements, the income requirements of the local incentive, and then you're dealing with what they can be approved for. I always say it don't connect like this, it connects like this. And that's where the challenge is. I don't have an answer. I wish I had an answer, but it is a challenge, and we just basically kind of work through it. You do have to do some hand-holding, some counseling, and I'm not talking about housing counseling. I'm talking about psychotherapy counseling with some people. Yes, we do end up being, therapy, because you end up getting to know the client. So you're hearing about what's happening with their kids or their spouse, or there's dynamics going on in a relationship. Sometimes if there's two people buying a house together, it's very interesting. It can be very interesting. It's like, oh, okay. Someone who, and then people are, as they say, people be people. And sometimes we have they come to us with their situation. I have to figure out how to work within the confines of their income, assets, credit, and family size. And the more tools I have in my box, which is why I've been at Truist for 11 years, because I have a lot of tools, I can match them together. And that's to say that I don't have a problem stacking together. I wish there were more. I wish there were more loan officers that would work with that and wouldn't be scared of it. It's not that hard. It's a little bit of an orchestration, but it's really, really cool when your client goes to closing. She's a school teacher, and she literally brought $361 to settlement. That is a cool thing when this person is out there and educating our little ones that are coming up. So.
Thank you for that, Tony. Okay, so everybody's been really patient. I appreciate that. I know there's a lot of pent-up desire to ask questions, so now is the time. George Leventhal.
So I wanted to ask two questions if I got. Tony, you said that times today are different.
You know what, George, you could take a mic. Yeah, that one walks around.
Hi. So my question is, in my experience, it's actually the reverse of what you described, where growing up, people stayed in multi-generational families, and now contemporary, there's more pressure to move out of the house. I actually, my life experience is just the reverse of that growing up, there was a lot of pressure to get away from your parents, that you were sort of viewed as not successful if you were still living in your mom's basement, et cetera. And what we're seeing now, including in my own family, is people in their 20s just finding it impossible to break into the housing market. And that it's a major change, I think, in usage of housing, that you have more that's my observation. Now it's anecdotal, but more multi-generational living. That's my first question. Second question, then I'll sit down, is the math seems to favor social housing. I mean, this is a tremendous story. It's absolutely fascinating that right up to our bond capacity, the county is able to issue tax-exempt municipal bonds, and that's clearly the most affordable way to finance any of this, more affordable than LIHTC. So the benefit of the public sector is huge based on these stories. And I guess my takeaway here is we need more public sector housing, more social housing. I wonder if that's a reasonable observation.
Well, Tony, multi-generational, is that more of a thing now, coming back?
Well, when I said that, I was talking more about, now you are seeing where the kids, you leave college and come back home to mom and dad, more so out of need, not out of want. What I'm talking about is the desire to still be out on their own, or using it as a strategic thought. Does that make sense? Whereas it's saying, I'm going to choose to go home, not that because I want. Before coming up, it was more socially acceptable than being at home. You look at somebody living in their parents' basement, they're 30 years old, and they're like, whereas it's I think it's more of a social thing of how you want to live your life.
Yeah.
You know what I mean?
I guess
so it's definitely different, and I think it may be different regionally, culturally, in different families. Yes, I just know that for me as a child, there was another generation in the household. There was actually even a boarder in the household. But yes, coming out of school is like, you know, but the times was different then. Homes were not as expensive then. Yes, in respect though, the incomes were different as well. But those two numbers were more in alignment than they are now. There's such a misalignment as to what incomes people are making now.
Right.
Coming out of school with an enormous amount of student loan debt, right?
Exactly.
Compared to where the price of homes are.
I guess that means that we should remove the stigma from living with mom and dad.
Exactly.
If we remove that stigma, that's actually a solution for a lot of people. We've got a lot of older parents living in very large homes, multiple bedrooms, that they could put to use, but they aren't doing it.
And also even, I've oftentimes made suggestions to clients when they are in this, certain limit as far as their income is concerned, and I ask them, I said, have you ever considered buying with someone? If your income is here, because I did it. I have never rented. I came home from college. I tried renting. When you're 22, you kind of think you know everything. But then after that short little 6-month stint, I basically came home and I was like, you know what? Why don't we pool our resources? Because my mom was thinking about buying. I hated where I was, and I was like, we're moving together. But mindset.
I wanted to ask Zach about this second question, because the question that occurred to me is, does the success of this revolving fund that you're taking advantage of with the county suggest that the market is mispriced risk for mezzanine and construction financing? In other words, are people getting away with, are the types of investors who are willing to make a construction or mezzanine financing loan basically getting away with murder because they're charging 15% on money that's maybe actually probably going to get paid back at a pretty high level of certainty?
Yeah, so we've made a pretty pointed approach of saying like the private model, do your thing, the nonprofit model, do your thing, which frankly there's a lot of overlap there. But what I would just say is that it's a really good question. It's definitely how we felt about our own projects. Like we felt that like HOC's ownership and the nature of what we're doing and the nature of the relationship between the county and HOC certainly is a very different risk profile than an LLC, like owning one property and doing a development. So I do think the answer is it's not so much that, private equity is or is not getting away with anything. I think if the trade is happening, the market likes it. So that's fine. But do we think there's space in there for if we weren't in the market, if the public sector was not in the market, that was what was, so it was being appropriately priced at the time. And I think what we're finding now is that there is a big role potentially for the public sector, that it can go into the market and it can do very well for itself, right? The government can do well for itself and actually, it can lend money in a way or invest money in a way that's actually just straight up profitable to the government, which should make everybody happy, whether you're interested in affordable housing or, lower property taxes. Like everybody should be happy if the government, is into something like that. So I think just the last thing I'll just quickly say is just, it's very clear this was, and we had no idea we were doing this, none, zero. We just were like, oh, there's a bag of money, right? There's a bag of money, I'm gonna go get it. So, but it's very clear this is a thing that we came up with something that was just untapped, because now, we've spent 2 years I've talked to, Hawaii, California, Bozeman, and the number of other governments that have stood up stuff, like Chattanooga just stood up one. Raleigh was at something on Friday where I was. They're about to do one. Chicago's done one. So it's very clear that there was what was really mispriced was the public sector was mispricing its own, really its own opportunity costs for not putting money to work in this way for itself, for this purpose. So.
Thank you for that. Who's there in back? Is that Randall?
Hello, everybody. General question, and this could be its own panel for 2.5 hours. What changes do you guys think we need to see in the market to eat into the housing deficit, which helps everyone in here?
I think we'll kick that down to Matt. How can we make market rate development work for more people?
Yeah, I mean, it's supply is it, right? In my world, supply is it. But there's, and I guess the purpose we keep having the same panel over and over again is that there's no silver bullet here. There's no, winged unicorn or whatever's going to sweep in and fix this. There's 1,000 bites at the apple. I think whatever the cliche is. So I think there's some prime movers though. And from my perspective, Casey's right. The money that's not taking risk, taking an extra percent, that percent ought to be given to the money that's taking the risk. So, we say private equity. Private equity is not a monolith. It's 11 to 18% loans that are taking no risk. And a project may underperform and only get 80% of its income, but that permanent money is only 75% of that loan. So they're going to be fine. And they get a fixed fee, maybe it's adjustable, whatever it is, but there's recourse for them and no risk. And moving that dollar figure over to the for-profit, it's all for profit, but for the risk-taking piece of the equity pie is really critical. Casey makes a great point. But then I also think, speed to entitlement. Obviously, we always talk about green tape, whatever it is, but and then I think local government taking on more of the responsibility of taking the hits to get the development approvals in faster. And more geared toward what the bigger plan is and not the NIMBY plan. And then I think on my end, we have to do the same kind of education of NIMBYs. We got to educate the investment groups about why a Green Street ranking of very landlord unfriendly government, which is what Green Street calls Montgomery County right now, loses a half point in cap rate, vanishes millions of dollars of my value, and educating them to not be so simplistic either. So there's this sort of natural reductionist sort of philosophy that happens at both the finance level, the Goldman Sachs level, as well as the neighbor living next door level. So those are some of the big levers that I want. If you can move the cap rate, if you can move the finance rate, I could build things all day long. So
I know a lot of people have to go, so don't feel bad if you do, but I hope you'll stick around for a couple more questions. Yes, sir. Oh, actually, if we could just hand you the microphone, that would be great.
My question is, will the state of Maryland promote what Zach's doing to all the different counties in Maryland to try to, because Zach, you mentioned Hawaii, Raleigh. What about right here, like, Prince George's County or Anne Arundel County? I mean, there's a real need, and if it makes sense, why aren't we duplicating this in our state?
Well, Zach, I know you've done your roadshow. A lot of people ask you to come talk about this. When you're done talking, are they still interested? And what do they do from there? Do you know?
Yeah, I mean, we've seen Atlanta go on and on. I mean, there's at least a dozen places where in the last 18 months they've stood up programs. I will say that the support at the state has been very receptive. Certainly, DHCD has been a longtime HOC partner across all the deals that we've done. It's a really good program, frankly, for housing finance agencies, period, because it's a whole different business line. So the issue hasn't really been at the staff level, and even our delegation, Delegate Vaughn Stewart, led a House bill last year that created an innovation fund to reward other counties in Maryland to do it. And I guess maybe the sharpest thing I'll say today is that, I've talked to, it's got to be closing in on 100 different jurisdictions and municipalities at this point. I've gotten precisely 0 calls from any other county in the state of Maryland. So it's kind of wild. I don't really know why.
Alan, is this something you're gonna go tell your friends in Arlington they need to, or Richmond, as the case may be, that they need to stand up something like this in the other side of the river?
The notion of leveraging the balance sheet strength and financial ratings of local jurisdictions makes all the sense in the world, because at the end of the day, it's not so much that the risk is mispriced, it's that the capital that's being used is actually government guaranteed, and the county's taking the risk and not looking for the return in terms of financial, but rather taking in terms of the social impact of creating the affordable housing.
Well, that's kind of what I was driving at when I was talking about the limits of this sort of approach. I mean, in what you're showing in your slides, it's not cost-free. There, the county is not getting paid back 100 cents on the dollar, and that's okay. It's like whatever it was, $2.7 million a year. That's actually, but it's still an efficient subsidy. If I read these numbers correctly, it looks like you're getting a lot of leverage out of not a whole lot of money. And yet, it still does require the county to put up some money, and that money is competing against school construction, roads, all the other capital needs, and the debt capacity of the county is constrained by the desire to keep a AAA bond rating and not have to pay higher interest rates, right? So to what extent is that a meaningful limit, or is that really just kind of a rounding error because you're able to get such efficient use out of this and get the money back that we shouldn't look at it like as though we're competing against the next school project?
Yeah, I'll just say two quick things. So one, because I can launch into a whole spirit journey, so one, we could set the percentage of loans to our projects to where it was literally no cost to the county today and for the entire duration of the loan. So it's not that much higher than 5, because obviously 5% is paying back 70% of that $7.7 million a year. So if we wanted to make it completely net neutral just out of the gate, we could. But the other piece I think just is really important is that it's that public equity, the retention of the equity in these assets, because the government's not taking, the county's not taking any real estate risk on these developments at all. It's a simple 20-year relationship, normal relationship. They do it all the time with bondholders, bond buyers, and they're making those payments. The county takes no risk related to the real estate itself. But because HOC is the owner, all that value that gets created stays basically within the government apparatus. So if you look at what will be dramatically net positive equity return to HOC, which is by extension, the county, I mean, it's not like that money's going anywhere. This is, again, this is the virtue of the public ownership that, the county could recapture some of that, or just simply not need to fund, projects as high, in future years. The 20-year bond gets paid back eventually. So all of these things are suggestive of the fact, because we don't let the equity and the value go away and disappear into the private sector, it's a total net profitable venture for the county government. And really the only distinction is a lot of that sits with HOC instead of coming back to the county. But that's, as I think most folks know, the relationship between the county and HOC is such that, it's a distinction with maybe a little bit of a difference.
Anyone else before I'm sorry? Yes, ma'am.
Good morning, everyone. Thank you. Okay, I have a real concern for affordable housing for seniors, but I have a general care about affordable housing for the average, American in Montgomery County. I work with clients at the low level, like Tony does, and I noticed in the new housing that HOC has acquired, the Leggett and the Laureate, that there's no special concern for seniors, because, for example, if I were to retire today myself, my income would be reduced by less than half of what it is right now. I could not afford to live in the Leggett or the Laureate. So even though it's billed as affordable housing, it doesn't seem to be as affordable as it is being billed to be. And one of the things we haven't talked about much in terms of the rents, well, what about utilities? I see clients who's paying for a one-bedroom apartment, Pepco bills of $300 to $500, $600 per month. So even if they could afford the rent, they cannot afford the utility. So what can be done to help families and seniors to be able to really afford the rent? Now, I had the opportunity, perhaps maybe a couple of months ago, to go visit Allium. I was very impressed because of the partnership that they have with Habitat for Humanity, because I'm familiar with Habitat for Humanity. My own daughter had a house built by Habitat for Humanity in Washington, D.C., so I know about them. And I was surprised that they were able to get free land. So I'm wondering what is the likelihood of that happening again, somewhere else in Montgomery County or anywhere else. So anyway, my concern is about the seniors, because I've been looking at some senior places and the rents are so high. So a senior's income is going to reduce once they retire. So how are they going to be able to afford, for example, $2,000 rent for a one-bedroom apartment plus utilities? So anyway, those are my questions. Thank you.
Who would like to talk about special considerations for senior residential projects? Anyone? I know we've got a few in the county that are affordable.
I mean, go ahead.
Yeah, I was going to say, to your question about seniors, we find most of our projects that are targeting senior housing under our bond program. I don't know if you were here when I was talking about the competitive natures of the 9% credits. So those don't lend themselves so much because they're smaller units, smaller bedroom type size units. And so our bond program, we do quite a bit of senior housing, and it does come with a strata of income for the residents, anywhere from, I'm going to say mostly they're probably as low as 40% AMI, sometimes 30, up to 60. And so we recognize the state of Maryland that we cannot accommodate senior housing. We have been not able to accommodate senior housing on the competitive side, but we do a robust number of senior housing on the bond side. I'm going to say, I think maybe 40% of our projects cover senior housing on the bond side of our ledger, if you will. And so we do handle it that way. In terms of cost or rent, it really is based on where you live. And then if the borrower or the borrower is trying to develop senior housing, do they have subsidy to go along with it in order to bring the rent down even further? If you're able to get those subsidies in your deal, and that's, project-based vouchers from a housing authority or some county or other entity, that helps that cost. But not every county or location has that ability to provide that. And so developers who can get it do use it and build housing using those vouchers or those project-based rental assistance in order to keep the price down for residents.
I think we're going to have to cut it off there because we're about to get kicked out of the auditorium. Ralph has a word from our sponsor. But while Ralph's walking up, could we applaud our panel and thank them for coming up?
I simply wanted to say, give great appreciation to the panelists. Casey put this together. It was an amazing education. I hope you'll publish your spreadsheets for us so we can tell the difference in cap rates and how we can respond to it. And to those who have been successful in the face of this complexity, it's amazing. So I hope we can reconvene this panel periodically because it has been tremendously helpful. So please join me again in thanking them for being here.